For nearly decades, central bankers treated gold like an embarrassing relic of the past. Back in the late 1990s and early 2000s, Western central banks couldn't get rid of it fast enough. Former Federal Reserve Chairman Ben Bernanke famously told Congress in 2011 that central banks held gold largely because of tradition, not because it was necessary for a modern digital global economy. Fast forward to today, and that perspective has been completely turned on its head. Over the past several years, global central banks haven't just been buying gold, they've been buying it at a pace rarely seen in the modern central bank era. For 3 consecutive years, from 2022 through 2024, central banks bought more than 1,000 tons of gold annually. Even in 2025, when record prices slowed purchases, they still added roughly 863 tons, far above the average pace of the previous decade. Nations like Poland, China, Turkey, India, and Kazakhstan have been buying gold by the ton. The critical question is, why? Why are the world's most powerful financial institutions, the very bodies that control paper currency, moving hundreds of billions of dollars into physical metal stored inside heavily guarded vaults? This isn't just a reaction to inflation or high interest rates. It may be a signal that the foundational rules of the international monetary system are gradually shifting beneath our feet.
To understand why central banks are accumulating physical gold today, we have to look back at how the world broke its link with metal in the first place and how paper took over the global monetary system. In 1944, delegates from 44 nations met at Bretton Woods to design a new global financial architecture. The rules were relatively simple. The US dollar was pegged directly to physical gold at $35 per ounce, and other major currencies maintained fixed exchange rates against the dollar. The dollar was considered as good as gold because foreign governments and central banks could convert their dollar reserves into US gold at the official price of $35 an ounce. In other words, under this system, governments could ultimately swap their paper dollars for physical gold. But by the late 1960s, the system was beginning to strain. The United States was spending heavily on the Vietnam War in expanding domestic government programs. At the same time, more dollars were circulating around the world, while America's gold reserves were declining. Foreign governments began questioning whether the United States could continue honoring the promise to convert dollars into gold at $35 an ounce. France, under President Charles de Gaulle, became one of the most aggressive challengers of the system. Beginning in the mid-1960s, France converted substantial dollar reserves into gold in repatriated bullion from the United States. Other countries also demanded gold, and America's gold reserves continued falling. Then, on August 15, 1971, President Richard Nixon delivered the ultimate financial plot twist.
On national television, he suspended the dollar's convertibility into gold. The Nixon Shock severed the final link between the US dollar and physical gold. The global monetary system was entering an unprecedented new era, an era dominated by fiat money, currency whose value no longer depended on the promise that it could be exchanged for a fixed quantity of gold. But without gold backing the dollar, something else had to sustain international demand for the currency, and the timing could hardly have been more important. During the 1970s, oil had become the lifeblood of the industrial economy. International oil markets were overwhelmingly priced in dollars, while the United States deepened its economic and strategic relationship with Saudi Arabia and other major oil producers. Washington also developed financial relationships that encouraged oil-exporting countries to recycle their enormous dollar revenues into American financial assets, particularly U.S. government debt. The process became known as petrodollar recycling. Countries participating in international commodity markets needed dollars. Oil exporters accumulated those dollars, and a significant portion of that capital flowed back into dollar-denominated financial assets. Gold no longer anchored the dollar. Instead, global trade, deep American capital markets, geopolitical influence,
and the enormous U.S. financial system helped sustain international demand for it. For decades, U.S. government debt became the dominant reserve asset of the international monetary system, and gold increasingly looked like an outdated alternative. It paid no interest, it generated no dividend, it cost money to store.
And for central banks operating inside a dollar-centered global financial system, government bonds appeared far more useful. But gradually, the calculation began to change. The first major warning came during the 2008 global financial crisis. The crisis demonstrated that even sophisticated financial assets and institutions could contain risks that investors had dramatically underestimated. But another turning point arrived in 2022. Following Russia's invasion of Ukraine, the United States, European Union, Japan, and other governments imposed sweeping financial sanctions. Around $300 billion of Russian central bank reserves held abroad became immobilized. Virtually overnight, reserve managers around the world were confronted with a risk that had previously seemed remote. Foreign reserves may be highly liquid, they may be backed by some of the world's strongest governments, and they may carry extremely low credit risk, but access to those reserves can still depend on foreign governments, financial institutions, and legal systems. If geopolitical relations collapse, those assets can potentially be frozen or made inaccessible. That added an entirely different dimension to the meaning of a safe reserve asset. Now consider physical gold. Gold has no traditional counterparty risk. It is not issued by another government. It isn't someone else's promise to repay you. And physical bullion stored inside a country's own borders does not depend on access to a foreign banking system or international payment network. If a country owns physical gold and stores it inside its own domestic vaults, another government cannot simply disable access to those bars through financial sanctions.
That makes gold unusual. It is simultaneously a reserve asset and a physical commodity. And in an increasingly fragmented geopolitical environment, that characteristic has become strategically valuable. The changing perception of foreign reserves hasn't gone unnoticed. Emerging market central banks in particular have become major participants in the recent gold buying boom. Take China. China has resumed a sustained campaign of reported gold purchases, steadily increasing its official reserves while diversifying its enormous reserve portfolio. At the same time, China's holdings of U.S. Treasury securities have declined substantially from their historical peaks. That doesn't mean China is abandoning the dollar, far from it. China still holds enormous foreign exchange reserves and remains deeply connected to the dollar-based international trading system. But gold provides something government bonds cannot, an asset that does not represent a claim on another country. And China isn't acting alone. Look at India. For decades, a significant portion of India's gold reserves was stored overseas, including inside the Bank of England in London. There are practical reasons for doing this. London is one of the world's largest gold trading centers, and holding bullion there can make international transactions easier. But in 2024, something interesting happened. India moved more than 100 tons of gold from the United Kingdom back into domestic vaults. By the end of September 2024, the amount of India's central bank gold physically stored inside the country had risen to more than 510 tons. Officially, the move was associated with logistical considerations and diversification of storage locations.
And that distinction is important. And after the freezing of Russia's foreign reserves in 2022, the distinction between owning an asset and controlling access to that asset has become much harder for governments to ignore. This doesn't mean countries are abandoning the dollar. The US dollar remains the world's dominant reserve currency and remains deeply embedded in global trade, finance, and commodity markets. But countries are increasingly looking for ways to diversify around it. And gold provides one of the few reserve assets that does not simultaneously represent somebody else's liability. So what does this institutional gold rush mean for the broader economy and for everyday investors? First, sustained central bank demand creates an important new source of support for the gold market. In traditional economic models, gold often struggles when real interest rates rise. The logic is straightforward. Gold pays no interest, so when investors can earn attractive inflation-adjusted returns from government bonds, the opportunity cost of owning gold increases. Historically, that could place significant pressure on gold prices. But something unusual happened during the recent cycle.
Interest rates rose dramatically, real yields increased, and yet gold continued reaching record highs. Central bank buying wasn't the only reason.
Investment demand, geopolitical uncertainty, currency movements, and expectations surrounding monetary policy also mattered. But official sector demand became an increasingly important part of the equation. And central banks tend to think differently from ordinary investors. They aren't necessarily buying gold simply to sell it a few months later. They are managing strategic reserves over years or even decades. That doesn't mean price is irrelevant. In fact, record gold prices appear to have made central banks more cautious during 2025. After 3 consecutive years of purchases exceeding 1,000 tons, buying slowed to roughly 863 tons. But here's what makes that number remarkable. Even after the slowdown, central bank purchases remained far above the average pace seen before the recent buying boom. That suggests gold is increasingly being treated not merely as a trade, but as strategic financial insurance. Second, the buying points towards a gradual transition to a more diversified international monetary system. Not necessarily the end of the dollar, and certainly not the return of the classical gold standard. Instead, we may be moving towards a world where countries spread their reserves across a wider range of assets: dollar-denominated securities, other major currencies, regional payment arrangements, and neutral reserve assets like gold. The dollar-centered system isn't disappearing, but governments increasingly appear reluctant to place all of their financial security inside any single monetary system. And that may be the most important reason behind the gold rush. Central banks aren't replacing the dollar with gold.
They're buying gold because they don't want all of their financial security dependent on someone else's monetary system. Gold spent decades being dismissed as a barbarous relic of a bygone monetary era. Yet today, in an age of digital currencies, financial sanctions, geopolitical rivalry, and enormous sovereign debts, the world's central banks are once again accumulating physical metal. Not because they expect paper currency to disappear tomorrow, not because the gold standard is returning next year, and not because the dollar is suddenly about to collapse. They're buying because gold provides something extraordinarily difficult to reproduce inside the modern financial system, an asset that requires no promise from another government. No foreign issuer has to repay it. No corporation has to remain solvent. And when it is physically held at home, access doesn't depend on a foreign custodian. That doesn't make gold perfect. It produces no cash flow. Its price can be volatile, and even central banks slow their purchases when prices become expensive. But when governments themselves begin worrying about inflation, geopolitical fragmentation, sanctions, and the security of their reserves, they continue turning toward an asset humanity has trusted for thousands of years. The gold standard may be long gone, but the extraordinary central bank buying of the last few years reveals something important about the modern financial system. When trust becomes uncertain, gold becomes valuable precisely because it requires so little trust from anyone else. And the trend may not be finished.
Central banks have accumulated gold at an average pace of roughly 1,000 tons per year over the past 4 years, about twice the average pace of the preceding decade. So perhaps the real question isn't whether gold will replace the dollar. It almost certainly won't anytime soon. The more interesting question is this: how much gold do countries want to own in a world where financial reserves are no longer viewed purely through the lens of returns, but increasingly through the lens of security? Drop a comment. Do you think gold is the best hedge against today's global uncertainty? Or have record prices already pushed the market too far? If you made it this far, hit that like button. Subscribe. New breakdown every week.